I wouldn't want to be a short in silver right now. Let's put it that way. I think that would be a dangerous bet. Now we're around 80, I believe. 82 perhaps it is today, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before. If the guys say it could be $160 an ounce, well, I believe that's possible. I can't exclude that it's not going to go to 300 or 500. That's possible too. Now, I'm not forecasting it. If I was going to forecast a price, I'd try and stick quite close to where we are now. And the 3-month future is selling at almost always a higher price than the spot month. That's called the contango. The amount of open interest in the March contract was many, many multiples of the available silver. As we went to the last day or two before the first delivery date, that open interest fell off a cliff very, very rapidly. Somebody brought their kids to work and he tripped over a wire or something and disconnected the silver market, but not any other market, and COMEX to a sudden lurching halt. And probably in that hour and a half, maybe a few phone calls were made. When the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B?
With respect to precious metals, especially silver, you've been following the markets quite closely and looking at the inflows and outflows on the COMEX. What is your latest analysis of what's happening? It seems like a lot of people are concerned that there's not enough silver, right? And that there's so much volume being traded back and forth. What are you seeing?
Well, let's just deal with a few simple facts. First of all, COMEX continues to be drained of silver. Silver is leaving COMEX. It's also I think we're at the lowest level in years. It's also leaving the LBMA. It's about half the level about 4 years ago. And it's also leaving Shanghai, the silver exchange. So where's it going? Well, it's being consumed. And the reason it's being consumed is because the electronics industry is demanding more silver than it's ever demanded before. We've had a decade of rising silver demand, much of which is coming from the electronics industry. We've had a decade of falling silver mined production. 4 or 5 years ago, we went into a situation where we passed from surplus to deficit, and the deficit every year now is growing larger. Looks like it will continue to grow larger. So the difference between mine supply, which is falling, and industrial consumption, which is rising, that negative gap is getting bigger and likely to continue getting bigger for as far out as the eye can see.
The quiet drain from global vaults is louder than any silver price headline. As Clive Thompson points out here, inventories at COMEX, LBMA, and Shanghai are falling while electronics demand hits decade highs and mine supply trends lower. A market shifting from surplus to persistent deficit changes the valuation floor, especially when industrial users are less price sensitive than retail traders. What's not said out loud is that shrinking exchange stocks tighten liquidity, amplifying volatility, and forcing institutions to rethink hedging exposure. Next, Clive Thompson discusses how above-ground stockpiles become the market's pressure valve.
So the difference has to be met from above-ground stocks of silver. And yes, if you ignore the falling supplies on COMEX and LBMA and elsewhere, there's quite a lot of above-ground silver, but there's nowhere near as much as there used to be. It's getting less. And as it gets less, you need to offer those who hold that silver an incentive to unload it. And the incentive is a higher price. So everybody has their price. And, you know, the surge in price we saw from, let's say, below $50 to over $100 at one point at the end of January was one of those surges which made an awful lot of people think, that's higher than the price I would have sold at. I'm out of here. So a certain amount of silver came and met the demand. But the evidence is that silver is still which came out, is still being consumed because we're seeing the supplies at the various futures exchanges dropping. So that nothing has really changed relating to the fundamentals of silver. And I think that it's quite possible, and I'd say more likely than not, that silver will continue to see higher prices as the industrial users who are relatively price insensitive. You can't stop producing cars just because the price of silver's gone from $50 to $150.
Price spikes aren't speculation alone. They're signals coaxing reluctant sellers. As Clive Thompson points out here, Above ground silver is the buffer, but it's thinner than in prior cycles, meaning higher prices are required to unlock supply. The January surge from under $50 to over $100 flushed some inventory, yet exchange stocks kept falling, implying industrial consumption didn't slow. What investors should notice is the inelastic demand from manufacturers, who can't halt production over metal costs, anchoring a stronger long-term bid. Next, Clive Thompson unravels why price-insensitive buyers reshape risk for shorts and long-term holders alike.
I mean, it's, what is it, $80? But you're not going to say, oh, I'm going to wait, stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price because most of the, we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. The easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing, in my opinion. And a growing deficit means that you've got to have a higher price to suck out the above ground silver.
I know that Bank of America, one of their analysts, actually projected in 2026 that silver could be anywhere from 130-ish per ounce to $300 per ounce. What is your perspective on these mainstream projections of silver being well above triple digits, even much more, many multiples of that?
When something is rising in price, there's always going to be people who want to get in the news by making a projection which is away from the crowd. And he might be right.
When both supply and demand ignore price, volatility becomes structural, not speculative. As Clive Thompson points out here, silver's byproduct mining model limits rapid output growth even after prices doubled, keeping deficits intact. Bank projections of $130 to $300 grab headlines, but what isn't emphasized is that constrained supply plus industrial dependency can justify repricing without retail mania. Investors should separate media shock targets from the core imbalance that forces higher clearing prices over time. Next, Clive Thompson discusses why bold forecasts often miss the slower compounding forces underneath.
But we've seen, I don't think they still do it, but if we go back a long time ago, the Wall Street Journal every year would publish a list of 30 or 40 or 50 analysts on where they saw indices like the Dow Jones and the Nasdaq. And every year after the year had finished, I'd go and look at where the bulk of the analysts lay, and typically the market finished different from where the consensus was by about 30%. Well, I say often by more than 30%. In other words, if they thought it was going to be up 12%, then the market would be up 42%. If they thought it was going to be up 12%, the market could be down 20%. In other words, they were 30% away. So it's fun for analysts to put a number on the game, but sometimes they can be very, very wrong. If the guy's saying it could be $160 an ounce, well, I believe that's possible, but it might go. I can't exclude that it's not going to go to 300 or 500. That's possible too. Now, I'm not forecasting it. I don't forecast things like that, but if I was going to forecast a price, I'd try and stick quite close to where we are now.
Consensus forecasts often miss reality by a country mile. As Clive Thompson points out here, historical analyst targets for the Dow and Nasdaq were frequently off by 30% or more, proving how fragile forward projections can be. That context matters when silver price targets jump to $160 or even $500. Bold numbers attract attention, but rarely capture liquidity shocks or sentiment extremes. For disciplined investors, anchoring expectations closer to current pricing reduces behavioral risk in volatile cycles. Next, Clive Thompson unravels how forecasting incentives distort what Wall Street chooses to emphasize.
That's what the wise analysts do, but the ones who want to get in the news will go out on a limb and forecast a very high price. Now, I do think it makes sense that it would go higher, but how fast and how squeezed it gets, you just don't know, because things can play out in many different ways. I wouldn't want to be. I wouldn't want to be a short in silver right now. Let's put it that way. I think that would be a dangerous bet.
Certainly, and I mean, a lot of people might look at the fundamentals, for example, when it comes to industrial demand, and point out that, a lot of people in our sound money community have been pointing these things out for years, and a lot of those bullish fundamentals might already be priced into the silver price at the moment. So as you mentioned, we already have had such a run from here. What kind of further room do you anticipate for silver to continue to run from here, though? Because we've seen a tripling of the price, right, over the last year, 2 years. But it seems like, that could certainly continue, but is there actually reason to think it will, in your view?
The supply and demand, as I said, are very inflexible.
Wall Street loves bold targets, but positioning risk often matters more than price targets. As Clive Thompson points out here, the real danger may not be missing upside, but being structurally short in a supply-constrained market that has already tripled in 2 years. When fundamentals are widely discussed, investors assume they're priced in, yet inflexible supply and industrial demand can extend cycles far longer than consensus expects. The quiet message is about asymmetric risk. Short exposure can unravel quickly if liquidity tightens again. Next, Clive Thompson discusses why inflexible supply keeps pressure building beneath volatility.
This is not oil. If the demand for oil goes up, they could just pump at twice the speed. That's an easy thing. You can't dig the silver up at twice the speed. It doesn't. It doesn't work like that. You can only get out so many tons of silver per day or per week or whatever it is. So what it comes down to is the demand and the supply. Now, I believe that what happened towards the end of January was a lot of consumers of silver, factories and so forth, who were manufacturing solar panels or electronics or whatever else, they became quite nervous and decided to stock up on something a little bit more longer, a bit more silver than just-in-time silver. So a lot of them would have had relied on just-in-time supply chains, and then they're seeing and hearing the price of silver's going up, the silver supplies at COMEX are going down. What if we can't lay our hands on our traditional supply from our traditional source when the time comes? You know what? Let's buy a bit more just in case. And I think that was one of the things which probably accelerated the move upwards. And now we've had, as a result of that rise, this catastrophic fall for many, where we come down from nearly $130 to $65 at one point.
Silver doesn't respond to demand spikes the way oil does, and that difference changes everything. As Clive Thompson points out here, mine output can't simply double when factories panic buy, which likely fueled January's surge toward $130 before collapsing to $65. That volatility wasn't random. It reflected supply chain fear and inventory hoarding by industrial users abandoning just-in-time models. What investors should note is that structural rigidity magnifies both rallies and corrections, creating trading swings inside a longer supply squeeze. Next, Clive Thompson unravels how volatility itself reshapes institutional positioning.
Now we're around 80, I believe. 82 perhaps it is today. You'll know better than I, Elijah, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before. And it could be in either direction. So I think perhaps now it's come down. Many of the consumers of silver feel less concerned that COMEX I won't say COMEX, less concerned that their traditional supplies of silver are going to dry up, because obviously some silver must have come out of the woodwork to drive the price down. The other comment I'd make is about the silver shorts. We've always had in the silver market the shorts. These are big bullion banks, and it's quite a legitimate play. Technically they're probably not uncovered because they got silver in place A, and they're doing the shorting on the futures exchange like COMEX. It's a nice, easy way to make money over and above your treasury return, because provided you've got the collateral to meet the minimum margin requirement, your collateral can be earning interest whilst at the same time you're selling a 3-month future, waiting for it to get a spot month.
When a market moves $2 in a blink, leverage, not fundamentals, is steering the wheel. As Clive Thompson points out here, bullion banks routinely short futures against physical holdings, profiting from margin structures and yield on collateral. That system works smoothly in stable conditions, but sharp price swings stress logistics and funding assumptions. What rarely gets highlighted is how institutional carry trades depend on calm markets. Volatility compresses that comfort quickly. For investors, this means short-term dislocations can emerge even in structurally tight supply environments. Next, Clive Thompson discusses how contango mechanics amplify pressure during rapid price shifts.
And the 3-month future is selling at almost always, a higher price than the spot month. That's called the contango. So not only are you making it on your money market or your treasury bill that you've got as collateral, you're also making it by constantly rolling over these futures. And from an economic point of view, you probably feel you don't have any risk because you've got the silver stored in London. And again, that might be earning as well, because perhaps on your behalf, they're lending it out and earning a fee for you as well. So the amount by which these bullion banks can go short is unlimited. But of course, when the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B? And we heard these stories about the smelters being backed up and unable to convert the London-sized bars into the 5,000 ounce bars needed in New York. And suddenly, they although they're financially covered, they got the silver in place A and they need it in place B. Converting to the right, moving from A to B and getting it to the right size bars is not as obvious not as delay free as they thought. So there was probably a little bit of panic amongst the silver shorts, many of whom were rushing to close their near-dated contracts, driving up the price as well.
Contango feels safe until logistics break the illusion. As Clive Thompson points out here, bullion banks profit by rolling higher-priced futures while holding physical metal, stacking yield on collateral and storage. The hidden vulnerability appears when rising prices force rapid delivery conversions, exposing bottlenecks between London bars and New York contract specs. Financial coverage doesn't eliminate operational friction, and that's where panic buying or short covering ignites spikes. Investors should understand that paper leverage magnifies small supply mismatches into violent moves. Next, Clive Thompson unravels how short covering cascades can redefine price ceilings.
There is a narrative out there that there are a lot of silver shorts still when it comes to the COMEX market, that silver is one of the most shorted commodities if you compare it to like yearly production, for example. What is your perspective on that? And do you think that you mentioned how that is probably right? Short covering is right. Caused the huge rise in price early this year, but is that still an issue in silver, that it's heavily shorted? And if so, it seems like that could be a very bullish factor going forward.
The amount of open interest in the March contract was many multiples of the available silver, many multiples. Now that, as we went to the last day or two before the first delivery date, that open interest fell off a cliff very rapidly. Now there were a few events around that. The rally which was going on stalled thanks to some circuit. I don't know if there was circuit breaking. I think somebody brought their kids to work and he tripped over a wire or something and disconnected the silver market, but not any other market in COMEX. But it sort of brought the rally, which was going on, to a sudden lurching halt. And probably in that hour and a half, maybe a few phone calls were made.
Wall Street calls it a healthy futures market, but open interest running many multiples above available silver is a leverage game few want to dissect. As Clive Thompson points out here, the March contract's open interest collapsed just before delivery, exposing how quickly conviction disappears when settlement looms. That's not organic supply-demand balance. That's positioning risk being managed behind closed doors. The sudden trading halt during a rally only fuels suspicion about how fragile price discovery can be when volatility spikes. For investors, that means headline strength may reflect short covering mechanics, not durable demand. Next, Clive Thompson unravels what this positioning shift could mean for the next contract cycle.
And common sense returned, and a lot of the longs and shorts together collectively closed their positions very, very rapidly. But what we have seen is a huge spike in the May position. So it'll be interesting to know what's going on in May. Are there people who are now going long or short in May? First of all, are the longs expecting to take delivery because they're consumers and they're making sure they'll be able to get it? And the second question is, are the shorts going short because they think they'll be able to lay their hands on silver before the time, or they actually believe that the longs aren't serious buyers? They believe that longs are just speculating too. We don't know the answers to any of these questions because we don't have that sort of insight. But what is perfectly obvious is there are immensely more open contracts at all times on COMEX than there is silver available to deliver. Many multiples of that. I haven't got the figure in my head, but it's probably more than a year's supply. I don't know where that silver would come from if people do want to deliver it, but in practice that's not what's being expected. People are expecting most of those contracts to, when they get to May, to roll over again. But it could surprise us.
A spike in May open interest while physical supply stays tight is a quiet stress test for the entire paper silver system. As Clive Thompson points out here, there are many multiples more COMEX contracts than deliverable metal, possibly exceeding a year's production. That imbalance works only if most players roll, not demand delivery. If even a modest percentage stands for metal, logistics and pricing could shift fast. For portfolio strategy, this isn't about conspiracy. It's about counterparty risk embedded in futures-heavy exposure. Next, Clive Thompson discusses whether May becomes another rollover routine or a genuine delivery surprise.
What is your take on mining companies going forward if prices remain at these levels?
The vast majority of mining companies, the last results they reported were for the quarter from June 25 to September 25. That was a time when gold was about 3,400 and I don't remember, still maybe $38 or something like that. Now we know that the gold is $2,000 higher than that average price in that September quarter. That means that if that price that we see today had been holding throughout the last quarter, and obviously it hasn't, it's been all over the place, but let's say it holds for the next quarter, it means they'll be making $2,000 an ounce more than they made per ounce in the September quarter. And I'm willing to bet that many of the gold mining companies had a cost of production of 3,000, say. So if they were looking at a price of 3,500, say, that's $500 of profit. Now, that profit's going to go from $500 an ounce to $2,500 an ounce if the gold price holds. And even more extreme for the silver price, where we go from, let's say, 38 to 80, it's more than double. And so we're talking about an increase of $42, $44, that sort of level, compared with a price of 38.
Here's the math Wall Street hasn't fully updated yet. Margins could be exploding while analysts still model last quarter's prices. As Clive Thompson points out here, if gold moves from roughly 3,400 to 2,000 higher levels, a miner producing at 3,000 an ounce shifts from about 500 in profit to potentially 2,500 per ounce. That's a five-fold margin expansion without digging a single extra ton. Silver's move from 38 to 80 doubles revenue leverage even faster. For long-term investors, that kind of operating torque can reprice equity sharply once earnings catch up. Next, Clive Thompson shows how this margin surge could ripple through mining valuations.
So you can imagine when you add that to what might have been a relatively thin margin, it means that for some companies, their profits going forwards, if all things stay equal, the price stays where it is, their profits will be many multiples of what they reported a year ago for the same quarter. So I believe we're going to see across the board higher profits in Q4 when they announce the full year results, and even if the price stays the same, even higher profits in Q1 2026. Those are results which we'll hear about in May, June, and July. Now, analysts typically review a company at the time of each set of results. So the last review of all these gold and silver mining companies, for the most part, will have been at the time of their last results, which would have been the September 30th results would have come out, would have been announced maybe mid-October or November, or in some cases December. So those analysts will have looked at the results, done a few adjustments, made some price forecasts based on what they knew at the time. But what they knew at the time was a gold price and a silver price, which is below where it is today.
Earnings models are still anchored to yesterday's metal prices, and that lag is where opportunity hides. As Clive Thompson points out here, analysts last updated forecasts around the September 30th results when gold and silver were materially lower than today. If current prices hold into Q4 and Q1 2026, profit comparisons year over year could look dramatic by May through July. Markets often move not on what is true now, but on when consensus finally recalibrates. For investors, that timing gap between spot prices and revised targets can drive sharp re-ratings. Next, Clive Thompson discusses how those revisions could mechanically lift valuations.
And therefore, when they do their next analysis, when the next results come out, and in many cases that's going to be in the next few weeks, they'll be doing their next analysis on with the knowledge that the company's average selling price in this quarter, at 30th of December, was higher than the average selling price in September, and the profits went up by so much. And then what they're going to do, they're going to extrapolate that rise into the profits and say, well, if let's say the average price in the December quarter was 4,500 and it was up 500, let's say, or 1,000, well, if $1,000 price rise produces this much extra, what's a $2,000 rise going to do? And they'll be extrapolating that and coming up, in my opinion, with higher share price forecasts than they had before, and in many cases in every case, higher earnings per share forecast than they had at the time they did the last one, which was mid-October. And when you have increased forecasts of profits from a company or increased sales or anything like that, there's a huge army of algorithms which says that's what we buy.
Algorithms don't debate narratives, they react to upward revisions. As Clive Thompson points out here, once analysts plug in a higher December quarter average selling price, they'll extrapolate margin expansion and lift earnings per share forecast above those set in mid-October. A $1,000 price increase already boosts profits materially. Models will quickly test what $2,000 does to cash flow and targets. That's when systematic funds and quant strategies step in, buying simply because estimates rise. For investors, the real catalyst isn't today's metal price, it's the revision cycle.